Strong earnings, Trump fears that the variant will slow down the recovery. And so we continue on our upward path. This is Bloomberg Wall Street Week. I'm David Westin. This week, Ken Rogoff of Harvard on the future of cryptocurrencies.
I don't know if it's almost like a form of modern art that, in the year 2100, you'll go to a Star Trek convention and buy a signed Leonard Nimoy poster with Bitcoin or something. I'm just not quite sure, where it's going to be in 50 years.
And tech investor Roger McNamee on the story of Netflix and why it's different from so many others.
I think Uber is a terrible business. The situation at Netflix couldn't be more different. It's a very substantial business.
We started out the week with a lot of worry. COVID cases were rising.
What we're seeing now in this country is a significant uptick in infections. We are practically pleading with people to please, if you're not vaccinated yet, seriously consider getting vaccinated.
People were putting their masks back on, and some were starting to think that the real problem wasn't that the recovery was too fast, but that it would be too slow.
There's probably more to go here on the downside. It's not fatal. It's just taking some of the froth out of this market.
But by midweek, things were looking better. Corporate earnings for last quarter started reassuring people that we were on the road back. And even more important, corporations seemed more sure of what they were seeing going forward, with S&P estimates jumping the most in decades. And that near panic attack from the first part of the week, along with the quick midweek recovery, were reflected in equity markets, where the S&P on Monday dropped the most in 2 months, only to recover to reach for new highs, ending the week over 4,400, and the Nasdaq reaching toward 15,000, while the flight to safety early in the week led to the 10-year yield Treasury yield dropping below 115 basis points and then climbing back to end the week a bit higher, actually, than it was back on Monday. To take us through the drama of the week, we welcome now Rupal Bhansali. She's Ariel Investments Chief Investment Officer of International and Global Equities and author of Non-Conventional Investing, Being Right When Everyone Else is Wrong. And my colleague, Gina Martin-Adams, she's Chief Equities Strategist for Bloomberg Intelligence. So welcome to both of you. Gina, let me start with you. Explain to me what happened this week, because it was pretty dramatic.
It was a relatively volatile week, particularly after, 6 months of pretty much continuous gains in the equity market. To have a little bit of volatility felt a bit uncomfortable for many investors. But certainly what we did see, I think you accurately captured, David, is the market gyrating around the Delta variant as well as inflation expectations, maybe a little bit of worries carry over from last week, which was more about global central banks, earnings playing a part of the story. But when we really dig into the details, we actually find that companies that reported earnings over the course of the last week have not derived any benefit from those reports. So certainly we are in the midst of a lot of mayhem, I would say, in the market, where investors seem to have kind of lost their footing. I think it's a continuation, frankly, of what's been happening since May, when inflation expectations peaked, when we started to price in peak growth coming over the summer. We lost a lot of leadership on the index, and that really took hold over the course of the last couple of weeks with a lot of on-again, off-again trading.
So, Rupal, you wrote the book Non-Conventional Investing. Explain the non-conventional approach to what's going on right now, because the conventional wisdom, I think, is we thought we were all going to rush back in, a lot of fears about inflation. Now, I think we're not quite as sure. But what's the non-conventional take on what's happening?
David, thank you for that. And just to correct you, it's non-consensus investing. And I'm known to be a contrarian. So here's, I think, a couple of things to note. One is that equity markets, I think, are paying more attention to the credit market, and rightly so, because the credit markets tend to be much more prescient about, future economic outlook, which ultimately then drives profit outlook for the equities. And the big dichotomy that's occurred in the last couple of weeks in the interest rate environment, where the 10-year bond rate has been correcting against all expectations and against all punditry views, which I'm going to call, are the consensus views that interest rates would rise, they actually did the opposite. They fell. And frankly, inflation has not been higher than the statistics have reported. CPI was over 5%. So you have a record level of negative real rates. And that's putting a bid onto equity markets, which is why every time you see any kind of pullback, they go right back up. And also, I think, to Gina's point, it's also caused a rotation in the market. People were all gung-ho about value making a big comeback. That was the consensus reflation trade. Well, guess what? That's been put to paid with what the interest rates are telling us, that inflation is not likely to get out of control. And that also caused a rotation into growth stocks versus value stocks.
So, Gina, let's come back to you on this. And I take the point, it's non-consensus. I beg your pardon on the non-conventional, non-consensus. But how much of the equity valuation right now is just supported by the interest rates being so terribly low? I mean, a lot of people were saying we're going toward the 2 level on the 10-year yield. And instead, we, as I said, dripped down below 115 basis points. I think we're about 126 now.
Yeah. Well, I think you have to think about equities relative to bonds in a longer term scope. I mean, we got to the point back in May where the equity risk premium relative to bonds had fallen out of its fourth quintile, really for the first time in more than a decade, which said to a lot of investors, hey, look, equities relative to bonds are no longer offering us quite as extreme value as they did. At the same time, inflation expectations started to turn over, and then the story was written from there. Right? By Monday's close, that equity risk premium relative to bonds had finally reached back into the fourth quintile, offering investors an opportunity to buy into a dip in the equity market for the first time in quite a while. And I think we did see that. Now, the question remains as to how much we should be paying for equities globally, how much we should be paying for U.S. equities relative to rest of world equities and the like. But I think that fundamental shift is important to note that, we've been sitting in this fourth quintile for so long, and the relative value of equities in comparison to bonds has been incredibly compelling. But we lost a little bit of that in that really strong rip into May. Now it came back with the sell-off that we've seen, and investors took advantage.
Rupal, one of the things I took away from your book, the non-consensus investing book, was you like to manage risk rather than return. You focus on not losing money as much or more than you do on making money. So in this world, what is the risk we need to avoid as an investor?
Spot on, David. To Gina's point, I think a lot of investors are thinking about putting money to work in equities simply based on a relative valuation trade. I think they should look at absolute value, intrinsic value, not relative. I think both equity and credit markets are quite overvalued. And frankly, instead of just looking at the earnings multiples on stocks, which is what most equity investors do, they should actually start paying attention to the debt multiple. And what I mean by that is there's been a record increase in corporate debt. That is a huge source of risk in the equity markets that the equity markets are not pricing in. If anything, 2020 increased debt levels rather than improve them. And so now we are sitting on a situation where not only is the PE multiple very high, but so is the debt multiple. So when you look at an enterprise value, which takes into account both market cap and debt, compared to earnings before interest and tax, EV to EBIT, we are at record highs in global markets, whether it's international, US. So it's not even a question of, where do you go? It's all of these things are extremely rich. That said, I'm also an optimist, despite being a contrarian. And I think there is a way out because ultimately we need to manage money. We need to generate returns. I think the playbook is going to be that which happened between 2001 and 2010, when we had a lost decade in equity markets in the US. While there was capital depreciation because indices fell, dividends came to the rescue. And if you owned high dividend yielding stocks, which actually paid their dividends, so you got to be careful and make sure they don't have a lot of debt. Otherwise, they can't pay those dividends like happened during COVID. If you own that kind of portfolio, you have hope in making positive total returns on your capital, which is exactly what happened during that decade and the other lost decade in the history of stock markets between 1968 and 1978. Dividends came to the rescue. That's how I would position.
So, Gina, I'd be curious in your views on that. As I understood what Rupal was saying is basically the stocks are fully valued if you look at price-earnings ratio, but we should be looking actually at leverage, something we don't even talk about anymore because when you have interest rates close to zero, who cares? But in fact, there is a lot of debt on the balance sheet of a lot of companies these days.
There is, and certainly the fact that rates are extremely low is supporting the degree of debt that's on corporate balance sheets, without a doubt. If we do have an environment, however, where earnings growth accelerates much faster than the environment we've been over the last 10 years, my view is that's the real contrarian view out there, is no one's anticipating that we're going to actually move into an economic cycle that's much, much faster, powering a free cash flow recovery that's much stronger, which suddenly makes paying back that debt look a lot better. So my question for Rupal would be, in an environment where dividend yield is attractive, you're certainly somewhat dependent on 10-year treasury rates remaining low and economic growth not skyrocketing. Would you change your perspective if you thought that earnings were growing much faster, or would you stick with that same strategy?
I would stick with the same strategy. I would actually, again, take issue with the fact that equity markets are missing or somehow predicting that there's going to be much higher growth rates. The bond markets are predicting the opposite. They are actually saying GDP growth is going to low, inflation is going to remain low, and this is why you're hovering around the 1% mark. This playbook is actually much more similar to Japan. For 10 years, Japan was the first country to do QE, and ultimately QE failed in spurring growth, which, by the way, is exactly what happened in the US. The 10-year economic expansion we had post-QE in 2009 was the longest, but it was also the lowest. It was the most anemic rate of growth. The reason, however, that profit growth still was better is because companies borrowed money to do M&A and to buy back shares. That's financial engineering. If you look at sales growth of companies, it was actually very lackluster. So I would argue that we are living on borrowed times, and Japan is the playbook in terms of what the outlook can be. Ultimately, Japan got out of its funk when corporates delevered their balance sheets. Today, across the world, when I do fundamental research, some of the strongest, in fact, net cash balance sheets are in Japan, and the worst balance sheets are in the Anglo-Saxon world, US and the UK.
Gina, I'm going to give you the quick last word here. Is that right? We're looking at financial engineering rather than real revenue growth?
I think that was a lot of the story of the last cycle. My view is that's not going to be the story of the next cycle. And the reason I say that is because I think a lot of the reason why sales growth was extremely limited over the course of the 10-year cycle that ended in 2019 is because, frankly, the household balance sheet in the U.S. was in complete disrepair following the 2009 crisis.
Yeah. And that's certainly
if
different
we're to look
today.
at where the household balance sheet is today relative to that period,
very different.
It's a completely different perspective.
Very
Households are completely flush with cash
Gina?
and sitting on the lowest debt service ratios in U.S. history.
Thank you so much to Gina Martin. Sorry, Gina. Sorry, I got to cut you off. Gina Martin Adams of Bloomberg Intelligence and Rupal Bhansali of Ariel Investments. Thanks so much. And coming up, Robinhood looks to make a splash at the end of the month as it plans to go public at a valuation that estimates as high as $35 billion. We talk with Karl Roessner. He's former CEO of E-Trade about the rise of the retail investor. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. Robinhood's Reddit army will soon be able to own a piece of the retail trading app, as the company plans to list on the NASDAQ under the ticker HOOD, and says its market cap may reach as high as $35 billion.
I think you can look at our vision broadly and say that right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Robinhood will join the ranks of Coinbase, worth about $47 billion, and Charles Schwab, which bought competitor TD Ameritrade and has a market value of about $130 billion.
We're seeing what technology is doing in terms of transforming the markets. Access to information, the ability to trade, empowering smaller investors is something that is very real, and it's really changing the market.
Robinhood boomed during the pandemic by providing easy access to retail investors, playing a starring role in the meme stock frenzy that took off back in January.
Robinhood is a for-profit business.
Doesn't that mean that trading on Robinhood isn't actually free to begin with?
I think we've proven that otherwise by making this the standard model by which brokerages operate now.
Its monthly active users have more than doubled in the past year, with 17.7 million as of the first quarter. That's up from 8.6 million in the same period back in 2020. The Robinhood IPO comes just a month after FINRA imposed a nearly $70 million fine on the company. That's a record for the watchdog. FINRA claims that the trading app misled its customers about margin trading and lapsed in its oversight of technology and approvals for option traders. To take us through the phenomenon that is Robinhood and how it fits into the much larger picture of retail investing, welcome now Karl Roessner. He's former CEO of E-Trade. So, Karl, thank you so much for being with us. Really appreciate it. Without regard to specifics of Robinhood, because we don't know what's going to happen exactly. They're going to go public. We don't know the circumstances. Give us a sense of this retail trade phenomenon. Is it here to stay? It's exploded, has it not?
It has, and thanks for having me, David. I think the way that I look at it, I mean, Gina just said it on the last segment, the retail household, during the pandemic and otherwise was flush with cash. So what do you start to do? You say, okay, I'm going to get in on some of the stock trading and I'm going to understand how to do it. And Robinhood has created a phenomenal customer acquisition machine. Right? The way that they put the app together, how easy they make it to trade, how easy they make it to open an account. It's seamless. It's very well done in terms of having that beginner trader really have the opportunity to go in and buy some shares. So, there are some different things that, we should talk about in terms of the risks involved to that first time investor, but I applaud them in terms of the customer acquisition and just the explosive growth that they've demonstrated over the past 2 years.
So, Karl, I want to talk about the risks, but just before we get to that, to pick up on what you just said, how much of this is because we were trapped at home and a lot of people, particularly, frankly, maybe some younger people, got some checks from the government and they wanted to put them somewhere?
Yeah. Yep. So I think it's to be seen in terms of how many stick around and how many continue to do this post-pandemic. But I do believe that it's here to stay. And once you show individuals and you start to educate them on dealing with their finances and how simple it can be once you start with a bank account and budgeting and then understanding where stocks and bonds and other asset classes can fit as you continue to grow and become a more savvy investor, I think places like Robinhood have really opened doors for people. So I do expect a great deal of that to stick around.
So, Karl, give us a minute or two on the risks. And as we talk about the risk, one thing I'd like to focus on, is it a risk to the investor, which is serious, you want to take it about, or is there a larger risk to the system that goes beyond the individual investor who might lose their money?
So I think there are both, actually. So just taking the individual investor first, which has always been, my focus. I think that first and foremost, there has to be the education. They have to understand that when you invest in stocks, when you invest in crypto or other asset classes, there's a complete risk of loss, right? Over the past couple of years and sort of the growth that we've seen, some of the meme stocks, the amount of money that can be made on trades, it's been rather fantastic upside for everyone involved. So you see a friend make some money, what are you going to do? You take that stimulus check, you take the extra dollars, you open up a Robinhood account and you get on the train, right? And you continue to make money. But there is that downside risk. And it's that downside that I think it's incumbent upon all of us work in financial services to really help that new retail investor understand what it is that you're doing, understand the options that they have to invest, to trade. Does that fit with their overall profile? Is that part of their budget, right? Can they actually afford to lose the money they just put in the stock market? We've all seen indications of those dollars turning very quickly from a profit to a serious loss. And that can be very damaging if those are the only funds that you have in your bank account. So that's sort of the individual side, and I just hope that we continue as a group to focus on education more so than gamification, right? I think gamification, as you use it to educate an individual, can be a phenomenal tool, but it can be very risky when you use that as part of enticing trading, and that's just a line that I think we're going to have to figure out as we go forward.
Just the word I wanted to go to, because my question really is, can you preserve the value of this business and move away from gamification? How much of the value really is getting to people to play it like a video game?
Yeah. So I think the playing it like a video game and making it easy to adapt to and easy to use is something that makes it such a great customer acquisition tool, right? Being able to get more and more people engaged. So I think it's important that individuals learn how to deal with their own finances, right? And that they understand that these tools are available. There are so many great tools coming onto the marketplace fintech, particularly in financial services, and the availability of applications for the consumer to really deal with their funds has just exploded. So there's some great apps out there. And I think, it's important that we continue to sort of nourish and flourish in that behavior of interacting with your cash on your own and starting to learn how to trade, and invest. So is that the only thing of their business model, or is that the only part that people are coming for? I don't think so. I think it's opened eyes of many around to say, I can do this, but that I can do this, you're often going to need some help, right? You need some either, whether it be professional advice, whether it be the right educational tools to help you understand how to move forward with your finances and how to deal with them in a safe and practical way.
This is really helpful. Really appreciate you being with us, Karl. It's Karl Roessner. He's former head of E-Trade, and now he's CEO of Lefteris Acquisition Group on the subject of Robinhood, which is supposed to go public by the end of this month. Coming up, we take a look at the week ahead on global Wall Street. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. It's time now for us to take a peek at what lies in the week ahead for global Wall Street.
David, next week gives us a pulse check on Asia's economic recovery, with South Korea, Taiwan, and Hong Kong all reporting second quarter GDP numbers. And as the earnings season gets underway in the region, Samsung and SK Hynix are on watch after Intel's soft sales guidance. Report cards from Asian car makers Tata Motors and Nissan will offer cues on consumption, and updates from Singapore Airlines and Japan's ANA are on the radar as the spread of the Delta variant continues to hamper aviation. Flight tracking firm OAG calculates that July 2023 is a more realistic timeline for a travel recovery to happen here in Asia. Danny?
We had Daimler, which has lowered the sales outlook for its main Mercedes-Benz luxury car division. It cited the global chip shortage, and despite that, though, the second quarter revenue did come in better than expected. Finally, we also had Novartis reporting second quarter profit ahead of estimates, and that's as the impact from the pandemic began to ease. Now, they still do see a slight impact on demand from COVID. That's specifically going to be on oncology and some generic drugs as well.
Thanks, Danny. The busiest week of the earnings season awaits, with 177 of the S&P 500 companies reporting. Big tech will be in focus, with Amazon, Apple, Facebook, and Microsoft. Ford and Tesla also on the slate, as are McDonald's, Starbucks, and Caterpillar. Economic data include home sales, durable goods, and the first look at those second quarter GDP numbers, which are projected to have grown at a more than 8% pace. That's on the back of vaccinations, fiscal stimulus, and of course, those business reopenings. And all this, of course, unfolds amid the backdrop of the latest Fed meeting. That's on Wednesday, and we'll hear if the FOMC actually discusses a tapering of some of those emergency monetary policy measures that were deployed during the pandemic. David?
Many thanks to Sophie, Danny, and Romaine. Coming up, Treasury Secretary Janet Yellen had her eye on cryptocurrencies this week, even as Bitcoin dipped back below $30,000. We talk with economist Ken Rogoff of Harvard about the future of crypto and what regulators are likely to do about it. This is Wall Street Week on Bloomberg. $30,000. That was the level in focus for Bitcoin this week. The cryptocurrency fell along with equities early in the week as concerns of the spread of the Delta variant rattled investors.
We see Bitcoin going up in value and down in value. So at times it's felt like a somewhat frothy market.
Bitcoin is down about 50% from the April peak, a sign that the bubble may be deflating.
I think something in the neighborhood of $15,000 is where we're going to end up. And, given all the uncertainty and the new competition from new coins and everything else, I think that there's more downside to go.
Crypto speculators are losing steam. Volumes for cryptocurrency spots and derivatives have slipped to their lowest since December.
Digital currencies are new. And in general, digital currencies are being debated as to whether they're an asset class or not. But the volatility that you see in it today, it is just has to play itself out over time.
Elon Musk gave Bitcoin a temporary boost at the B-Word conference hosted this week by the Crypto Council for Innovation, saying he personally owns Bitcoin, Ethereum, and Dogecoin, while Tesla and SpaceX both own Bitcoin. Cryptocurrencies plunged in May after Musk said Tesla would stop accepting Bitcoin as a form of payment because of the energy used to mine Bitcoin.
And we want to do a little bit more diligence to confirm could confirm that the percentage of renewable energy usage is most likely sort of at or above 50%.
Bitcoin's status as a store of value is one of the things that separates Bitcoin believers from skeptics.
I don't completely buy the whole thing. You're essentially saying that we're going to create a store of value and a medium of exchange around something that only exists inside of a computer somewhere. It's not a physical asset.
This idea that it's a hedge against confiscation of wealth, and that can take place in a myriad of ways. But inflation, and especially hyperinflation in emerging markets, is the primary way.
Treasury Secretary Yellen is among those who wants more scrutiny of cryptocurrencies. This week, she convened a meeting of regulators and policymakers to discuss the growth of stablecoins and the potential risks to consumers.
I think cryptocurrencies, we don't really have an adequate framework to deal with the different issues that they pose from a regulatory perspective.
One of those who's raised at least some questions about the future of cryptocurrencies and whether regulators in the long run can just let them run is Ken Rogoff. He's professor of public policy and of economics at Harvard University. So, Professor, thank you so much for being with us. As I say, I don't want to put words in your mouth. You've expressed some skepticism about where this all is going. One of the things we just heard there is there's just so much volatility involved. On the other hand, there's something called stablecoin. I guess stablecoin is tethered to specific fiat currencies to try to eliminate some of that volatility.
Yeah, there are a lot of different kinds of stablecoins, but the basic idea is something that you can exchange for a dollar in fiat currency, just like you used to be able to exchange gold. Of course, then you're not speculating on it in the same way, but the idea is to try to give stablecoins some of the attractive pseudo-anonymous properties that Bitcoin has, which is, I think, a lot of the underlying appeal.
At the same time, my understanding is theoretically stablecoin says whoever is issuing these has those dollars or yen or whatever reserved against those to tie to them. How do we make sure that happens? And is that really what Janet Yellen's concerned about as she meets with regulators?
Well, I don't think that's the only thing she's concerned about. I mean, I think regulators are very late to the game here in general in thinking about cryptocurrencies. They should have been thinking about it years ago. Certainly the stable coins are not necessarily stable. That's a long history of fixed exchange rates. It's the same thing. You make money by using the money that you're supposedly holding in escrow and speculating. It doesn't always go well. It leaves you vulnerable to attack. I actually think in the very long run, if stable coins persist, and I think the central banks are more sympathetic to them than anything else, they probably will need access to the central bank's balance sheet, just like banks do, to deal with runs.
So give us this the spectrum here, from Bitcoin to stablecoin to a central bank digital currency. Is it inevitable we're heading towards central bank digital currency?
I think it's inevitable we're heading towards central bank digital currency, but it's not the same thing. And I've heard Governor Powell say, well, we want to take away some of the appeal of Bitcoin. No, you won't. Yes, for doing certain digital transactions, it may be more convenient than using MasterCard or other things, and we may be headed that way. But obviously, if it's issued by the central bank, it's very hard to have the same kind of pseudonymity that you can get with Bitcoin. So I think I believe they need to sharply regulate the anonymous cryptocurrencies. I know a lot of people in the cryptocurrency world probably hate me for saying that, but I do think it's coming. And we're probably headed towards some world in which, at least under duress, the government can fairly easily find out about transactions, even if it's not monitoring them constantly.
Well, I wonder about just the mechanics of that regulation, because I think a lot of transactions in Bitcoin or another cryptocurrency are done offshore. They're done through corporations that are not U.S. corporations, and they're done, as you say, pseudonymously. So how do you regulate that? Is it possible?
Well, that's a good question. I've been thinking about it a lot for a long time. You can't totally shut it down if North Korea and Russia and Iran decide they're going to use it. That provides a home for it. What you can do is make it much harder to use, say, to buy Tesla in advanced countries, probably in China. That prevents it from having the same value. I've actually always been careful not to say Bitcoin is going to zero, like many people, Nouriel Roubini, for example, has, emphatically, because I don't think that's going to happen. But I think as the guardrails tighten, its appeal is going to go down. Maybe its value is going to go down. Who knows?
Well, you wrote a book back in 2016, as I recall, that sort of laid this out early on. I'm not sure people paid enough attention to it at the time. It's much more relevant in some ways now. At least we realize it's relevant. And so what is the history, and how does it apply here? What do you think happens? First comes regulation, and then does the government take it over altogether?
If you look at the history of money, and of course there's more going on with cryptocurrency, but if you look at the history of money going back from standardized coins in Lydia in the 7th century BC, up through the first paper currencies, Kublai Khan, that Marco Polo discovered, and many times again and again, the government of the private sector always is inventing it, and the government eventually regulates and appropriates. And something like that's going to happen here. And there, people who say, oh, the government isn't going to win. Well, the government makes the rules, and they can keep tilting the playing field. They can do all sorts of things if they want to. I think the idea ought to be to strike a balance between allowing some privacy in transactions without allowing massive transactions that are private, and obviously things like ransomware, terrorism, and stuff. Bitcoin's just made for that, and we need to have much better regulation.
We now have the Federal Reserve saying that they're going to have a paper later this summer out on the question of cryptocurrency. So they're at least easing their way into this. But there are some governments around the world, let's name China, for example, that seem to be aggressively pursuing this. They've set it as a goal for them. Are we behind China, and should we be concerned about that if we are?
Well, I think one of the reasons we're behind China is we didn't want this to happen. The U.S. dominates global financial markets. We win under the current rules. We don't want to change them. And that's, of course, all the more reason that China finds some appeal to experimenting with this. I don't think we need to worry excessively that we're behind. As long as we're moving along and thinking about it, we could act potentially fairly quickly. But I think we have our head in the sands if we think we don't eventually need to do this.
So one more thing that I've heard about, and I wonder what your reaction is. Some people think that if we move to a central bank digital currency, it may disintermediate our existing banks, that people will just have bank accounts with the Federal Reserve and maybe use the existing banks as service agents, but they won't have the same role they have in the past. Is that fair?
David, that is the number one issue central bankers worry about. It's the reason they haven't been rushing headlong into this. Everybody's thinking about, what coins the government's going to issue, that the banks issue deposits. But it's really the other side of the bank's balance sheet that concerns governments. Who's going to do some of the lending they do? We have all sorts of new things developing, through the internet, all sorts of new age ways of doing lending, but they're not matured. They're not regulated yet either. And I think as those things come into being, the governments may get less tense. Will we have banks in 30 or 40 years as we know them? Quite possibly not. But the government is in no rush to have that happen overnight, and nor should it be.
At the same time, briefly here at the end, Ken, I might trust J.P. Morgan, for example, or Bank of America to know some of my transactions in a way that I won't the Federal Reserve, much less the Central Bank of China.
Well, the Central Bank of China probably knows everything about its citizens already. There's facial recognition, et cetera. Right. You're raising a very good point, David. This is part of a larger issue of information, encrypting phone calls, encrypting everything we do. Where is the balance between privacy and the public's need to know? And people are very, very strong on both sides, but we need to strike a new balance because there are these new technologies.
Yeah, it's fascinating. Great to have you on this. We have to have you back because there's a lot more to talk about. He's the man who has literally written the book on it. He is Professor Ken Rogoff of Harvard University. Coming up, does Netflix keep on going now that we're all able to get back out of our living rooms again? We talk with tech investor Roger McNamee about why he's still a believer.
The big issue for Netflix is that they won round one of the streaming wars.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. Netflix was out with its earnings this week, and it underimpressed investors because the growth pattern didn't look quite as robust as it has in recent quarters. But it also raises questions about these big tech companies that have come from almost nowhere, but what their future is in terms of growth, but also, frankly, in terms of government regulation potentially. We're welcome now somebody who comes from this industry. He is Roger McNamee. He is a co-founder of Elevation Partners, and of course, he is the author of the famous book, Zucked, about his experience with Facebook. And yes, I think it's fair to say some questions he raises about Facebook. Thank you, Roger, very much for being with us. First, let's start with Netflix. As I understand it, you actually own some Netflix. You like the company. So give us your sense about where Netflix is and where it's going.
So, David, I think the big issue for Netflix is that they won round one of the streaming wars. And that has forced every major media company into the marketplace. And as I think investors know well, Disney and Apple, HBO have come in with really strong offerings, and Hulu and others are coming up as well. And so from Netflix's point of view, they've gone from having the space to themselves to having to compete against people who have real libraries, real content, and are generally speaking very well financed. And to me, the sense early this summer, over the last couple months, that quarantine was coming to an end and that the pandemic was over meant people were going to watch a lot less TV than they were watching when they were quarantined at home. So it's not surprising that this quarter showed a lot lower growth in new subscribers, but I'm afraid that the pandemic isn't over and that Netflix is still the strongest player in that marketplace. So I do expect the company to rebound from this. And I think the future is still bright, albeit with a lot more competition than it had in the past.
Yeah, Roger, I must say, it certainly is the strongest in this space. The question is, can it maintain that or not? Because as you say, a lot of people have come in. Warren Buffett likes to talk about a moat around the business. Does it have a moat around the business, or is that moat just spending money hand over fist in new content? Can it keep that up?
Well, to be clear, that strategy has worked unbelievably well, and I don't know why it would stop. I think they have really large advantages there, relative to Disney in particular. And actually, I think this is true of HBO as well. Netflix really does have a new programming advantage. And I think they understand their audience better, and they just have a lot more experience doing this. Now, at the same time, I think there are other markets in which they can expand. They're testing things around games. I think that, conceptually, you could imagine them eventually getting into other forms of streaming, podcasting or music or whatever. And I don't think that they're locked into anything narrow. I think the brand is really good. I think that the team there has just demonstrated time and again that they have a much clearer understanding of what the audience needs than anyone else does. And I think that's still true. At the same time, we have to be cognizant of the fact that not everybody is going to wind up with an infinite number of streaming subscriptions. So Netflix is going to have slower growth eventually, but I think it's going to remain an extraordinarily high profit margin business. And I think its position in the marketplace will remain solid even with all the competition that's out there.
Roger, you raised the issue. You mentioned gaming, for example. Does Netflix have to have, well, I'll call a second arrow in its quiver? I mean, certainly, you talk about Disney, whatever you think about strength or otherwise, they've got several lines of business that can really cross-subsidize and really support them through lean times. Does Netflix have to go the way, perhaps, of Uber, when they said, let's be Uber Eats, not just Uber?
Well, to be clear, I think Uber is a terrible business. And each time they're expanding, they're looking for a market that is going to have legs for a long period of time. I think Uber is, frankly, the triumph of unlimited capital over a terrible business idea. The situation at Netflix couldn't be more different. It's a very substantial business. And I think the question is less, do they need the arrow in the quiver? Rather, are there arrows that they could put in their quiver if they want? And I think the answer to that's an emphatic yes. At the same time, again, I think investors need to be changing their expectations for these large tech companies. I don't think the kind of growth rates we've seen in recent years are going to be sustainable. And this isn't just about streaming. I think that's going to be true everywhere.
Roger, we also have a government in Washington. It's paying a fair amount of attention to big tech companies, including places like Google and Facebook and Amazon. What kind of risk or even opportunities could that pose? And let me raise one possibility with you when it comes to Netflix. We have this executive order out that's really from the president saying he doesn't like mergers very much these days. Could that benefit Netflix? Because as the largest player, it may make it more difficult for some of the other players to get together to challenge it.
So, David, I think that the situation with the government is really different today than it was even 6 months ago. So the Biden administration brought a professor from Columbia named Tim Wu into the Council of Economic Advisors. It then appointed Lina Khan, a tech reformer, to be the head of the Federal Trade Commission. And yesterday it announced it was going to appoint Jonathan Cantor to be the head of the Antitrust Division of the Justice Department. These are three extraordinary people, all serious tech reformers. And I think what investors need to understand is that antitrust is the most pro-growth form of government intervention on earth. Historically, it's been fantastic for investors. It does require changing your investment strategy, but what winds up happening afterwards is the target companies tend to grow more slowly, but they still grow, and then you get whole new industries that come out. The history of that in technology has been 100% of the time. Antitrust has led to a new industry and great new wealth opportunities for investors. So we should be embracing it, not fighting it. The problem in tech, and this is really a huge issue for the internet platforms, but I think it's much broader than that. It affects artificial intelligence, it affects facial recognition, a lot of the new technologies we see out there, that there are serious consumer safety issues. And I think the industry is today where the chemicals industry was in the 50s, where the garment industry was when it depended on child labor, where the food and drug industries were before the creation of the FDA, when food and pharmaceuticals were unsafe, where the railroad industry was before the regulation of that industry. So I think it's the right time that this industry has undermined public health by amplifying disinformation about the pandemic. It has undermined democracy by being platforms for the creation of things like QAnon and also the insurrection. And these are really serious issues. And I think the thing that investors need to do is to recognize that there are at least three tangents that the Biden administration can do without any kind of new legislation. There is an antitrust case that the Attorney General of Texas has created against Google and Facebook for price fixing in the advertising market. That is a really serious issue. And if the federal government takes on that case, they can pursue it as a felony. And price fixing is the worst economic crime you can commit. And so the standard remedy is 3+ years in prison for each count. And if I read the Texas case properly, there are 2 counts there affecting the executives at Google and Facebook. That's a huge deal, and investors haven't focused on that at all.
Well, that's really, really good advice. Certain people should take it into account and decide making their investment decisions. Thank you so much to Roger McNamee. He is co-founder of Elevation Partners. Coming up, one more thought on why the COVID virus isn't the only thing that may get in the way of the Tokyo Olympics as they get underway over in Japan. This is Wall Street Week on Bloomberg. Finally, one more thought. When is a delicacy just a pain in the neck? Pity the poor organizers of the Tokyo Olympics. When Tokyo won its bid back in 2013, there was no way for it to know that by 2020 it would be in the middle of a once-in-a-century pandemic.
That the games of the 32nd Olympiad in 2020 are awarded to the city of Tokyo.
And let's be frank, as great an honor as it may be, it's not always been a great business proposition for those cities holding Olympics. But then the pandemic hit, and pretty much no one wanted to travel to Tokyo a year ago, or for that matter, anywhere else. So Tokyo 2020 had to be postponed a year, upping the cost to over $15 billion. And those are the official numbers. A government audit suggests it may be more like $25 billion. And it's not just the expenses. COVID is hitting the top line as well. A COVID surge in Japan means that there won't be anyone in the stands, leading to a loss of some $800 million in revenue. But despite it all, Tokyo 2020 has stayed the course, even sticking to its brand name, although that means that Tokyo 2020 will actually be held in 2021. And the games have begun, complete with all those COVID tests and quarantine, and some athletes testing positive and having to drop out. And if all that weren't enough, now they have to contend with oysters. Yes, I said oysters. It turns out that the waterway where the canoeing and rowing events will take place may be infested with rogue oysters. According to the Washington Post, a trial run back in 2019 showed that the devices that they have to have in the water, that's to prevent waves from ruining the competition, well, all those devices were sinking. When divers went down to investigate, they found 13 metric tons, or over 31,000 pounds, of oysters had attached themselves to the equipment. They've now spent about $1.3 million, that's so far, to keep the equipment on top of the water rather than under it. But there's no guarantee that it's all going to work. It's not much of a consolation that this particular type of oyster, the magaki, or Pacific oyster, is considered by some to be among the best in the world to eat. They don't want to eat them, they just want to keep them out of the way. But then again, maybe they shouldn't be eating them anyway. July doesn't have an R in it, does it? That does it for this episode of Wall Street Week. I'm David Westin. This is Bloomberg. See you next week.